Hey, welcome back, everybody, to today's Market Explained, the FourStar Media Experience and Podcast. I'm Brian Castle. I'm your host, and here is Chris Reardon. Chris is my longtime co-host. Chris, welcome to our latest episode of the Today's Market Explained.
Thank you, Brian. Glad to be here. Glad to talk a little bit about the crazy markets, at least today. But
Yeah, what a day, Chris, to be doing this. It's quite a consequential day. We're going to talk about this and what it means, and there's a lot of confusion. But let me just first point out that Chris is the Director of Development for FourStar Wealth Advisors in Chicago. He's a Cleveland boy, so he still loves. I'm going to call him the Indians, Chris. I'm never going to call him the Guardians. And he's got a young family, including two young twin boys. So, Chris, welcome again to the podcast.
Thank you, Brian. Thank you.
And I'm the CEO and founder of FourStar Wealth Advisors. I'm the Chief Investment Officer, Chief Compliance Officer, seem to be Chief of everything. But nonetheless, I'm also husband to the amazing Tripti and dad to two wonderful young sons, Quinn and Evan. So, and I am here to kind of lead our discussion today about the crazy economy that we're in because of the changes that our president is looking to cause in the world economy. So it's pretty interesting stuff. So today was, what do they call it? Redemption Day?
I think it was yesterday was, I thought,
Redemption Day.
Liberation Day?
Liberation Day, that's it. He's going to impose tariffs all over everything. And so today is the first day the markets could react to it because he was doing it after the market closed yesterday. And he had this big board showing all the tariffs he's going to impose on countries around the world. And, Chris, the shocking thing for me is how much other countries did tariff us. I understand what President Trump is trying to do. And I think most folks think it will end up being a positive long term. Certainly, certain industries in America think it'll be a positive because the industries will be stronger in America, albeit maybe slightly higher prices. But that shocked me. The board with all those tariffs, countries with 72% tariffs and 65% tariffs on everything we sell them.
I mean, there certainly is that, I don't say misnomer, but there is, I think, a lack of understanding as far as what other countries do tariff the United States. I mean, I think that in an optimal world, obviously, there'd be no tariffs. It's essentially just kind of free trade, and that, drives economic innovation. It drives, everything. I mean, we don't want to have companies that are insulated, right? That are, we don't want there to be non-competition, right? We want competition because that's going to drive innovation. It's going to drive efficiencies. We saw that. We've seen that in the past. We've seen that with the car manufacturers. I mean, look at what Japan did, with their kind of dynamic approach to car manufacturing. So, I think that it'll be really interesting to see kind of how this plays out. I mean, I don't think that President Trump is putting these in place to, obviously put these in place for indefinite or for forever. I think there's an ends to a means with this. So we'll kind of see what that is. I think the instability we're definitely going to see in the short term, though, is no one really knows what's going on in Trump's head, what that end result is, and what needs to be achieved, and what's going to happen between now and then, right? So that's, I think, the big instability, and the market hates instability. CEOs hate instability. So you are going to see a lot of short-term volatility out of this as this ripples through.
Yes. Well, and I have the thing right here, Chris. The top country on his list, the top tariff, was China. So everything that goes into China, including a measurement of currency and manipulation and trade barriers and tariffs, is about 67% cost. So everything that we send over to China, they add 67% tax the people, their own people, I guess, right? And then of course it makes it harder for people to buy American goods there. The cheap goods are cheaper elsewhere. So, and a lot of times companies will not even bother. They won't even bother tariffing. So we've heard a little bit about how, well, really some companies, really very few companies have ever been subject to that high tariff. Well, of course, if you had a high tariff, maybe you wouldn't import goods to that country. So maybe they aren't subject to them, but they're not subject to them because the barrier is too high, right? And they don't bother. But European Union in general has a 39% tariff, Just a few more here. Vietnam has a 90% tariff. Taiwan, even our friends, semiconductors, 64%. They're turning around now building a big semiconductor plant in America as a result of that. Even India is 52%, South Korea 50%, Thailand 72%, Switzerland 61%, Indonesia 64%, Cambodia 97%, Bangladesh 74%. So all these countries are heavily tariffing everything that we bring in. And so, President Trump is a politician now. He was a businessman before, but there's always an element of self-preservation. So no one can believe that he would try to do this tariff to try to, hurt America, right? So he thinks it's going to work. And we are starting to see some countries negotiating really quickly here to try to get their tariffs lower so the president doesn't impose reciprocal tariffs or discounted reciprocal tariffs on them. And so we're starting to see all that lining up. And some countries have said, we're just going to let it go for a while and see how it is. Or in some are saying, we're going to negotiate now. We don't want to lose the business. We don't want to lose the activity. They want to be able to sell goods into America. We're the world's biggest market, biggest economy. So that's what's going on. And so, Chris, it's really rankling our markets because there is a hell of a lot of uncertainty, as you said, right?
Yeah, I mean, and just like with anything, I mean, I think there's a risk to this too, right? I mean, I think obviously you have the political risk, the international risk, which, I mean, it has rankled the international community. But I think the one thing that, and I'm sure they're accounting for this, but do they risk driving more countries to sign trade agreements with like China or some more adversaries like Japan, things like that, Vietnam, if we do this? So it's a delicate game to play, right? There's definitely things to benefit from it, but there are risks. So I'll be really curious to see how, as I said, how long this kind of goes on. I don't think it's something that President Trump plans on having in place for the next 4 years. So how long it kind of plays out and what's his end goal? And I'm sure there's end goals for each country are a little bit different. But it's just going to be interesting. And as you said, Brian, I mean, I think the markets today got hit really hard. Kind of came funny enough off of a rally yesterday, even though it was announced after the market closed that President Trump would be announcing the tariffs. I think a lot of the rally yesterday was based off of the expectation that they were going to be lighter than anticipated. And after that, they came out, they were heavier than anticipated, than the market was anticipating, and hence we got the heavy reaction today. So there's the market's going to digest it. Like I said, I think we're going to see a lot of volatility in the short term. And it's a really tough market. It's an event-driven market. So we could see news come out next week lifting some tariffs, and that could pop the market up there. So it's a tough market. There's a lot of unknowns out there. We can just really, manage with what's in front of us.
Yes, and we've got a really strong reaction to this, and we've taken some moves that are called the FourStar protection plan in managing money for some of our proprietary clients at FourStar. So we'll talk all about that. There's ways to manage through a very, very difficult market. But so, Chris, normally we start out right about with saying what's going on with the markets, and this time it was all about tariffs. That's really the big story today. But let's go back to the markets now, and let's see the 6 asset classes that we track in dollar terms worldwide. What do they look like right now? What's number 1 through 6?
So number 1 is still domestic equities, but we have seen significant deterioration there. I think on the last podcast we talked about, I think it was down about 18 points. It's down another 6, kind of podcast to podcast, if you will. So it's at 297 now. So it has dropped below that 300 mark. And commodities in the number 2 position actually gained 6 points. So it kind of absorbed those 6 points from domestic equities. So it's at 279. So that gap is closing fairly quickly. Whenever we see one asset class losing and another one gaining, obviously it's a double whammy, right? They're both closing very quickly. So we could see commodities overtake domestic equities. We could see it kind of pull right up next to it, but never overtake it. We'll just have to kind of wait and see. It seems like commodities have a lot of momentum right now, whereas domestic equities seems to be waning. Interestingly enough, in third position, international equities is still remaining unchanged or flat. It's at 221. So we haven't seen a major uptick there. It has been moving slowly up, but very, very slowly. And then our bottom three asset classes have been relatively stagnant. Cash in that fourth position is at 131. Fixed income is in fifth at 85 tally points, and currencies is in sixth at 78 tally points. And all those are unchanged from the last podcast. So relatively stagnant, those bottom three. We really haven't seen that. And I think the important thing to point out, when we have heavy market crashes, cash, we usually see that accelerating upwards. And we haven't seen that yet from an asset class. Obviously, commodities is gaining a little bit more. International equities slowly picking up here and there, but we haven't seen that quite yet. So that'll be interesting to see if we really see that tick up, maybe following this tumultuous week.
Yes. Well, so as you said, there wasn't a lot of change in the asset classes, but now, of course, the numbers coming in from this market will make things a little bit different. But when commodities are leading the economy, that's generally not a good economy, right? And so commodities are just a few tally points from being in the lead again. That's the way it was in 2022 when the really, really bad market, really, really bad economy. That's the way it was in 2008 when we fell into the Great Recession of 2008. The only thing that was leading at that time was commodities. So we're getting there now. But Chris, you look at where we are in the market so far for the year. The S&P 500 is only down about 8.2%, but it feels like a lot more than that because market was a lot higher. Right, January was like up 5-6%. Seemed like we were starting out for a pretty good year. And then the Nasdaq, the tech stocks were up almost 10%. Now they're down 14%. So if you go 20% down from the high, that's a correction. Actually, that 10% is a correction, 20% is a bear market. So we're actually in bear market territory for the Nasdaq, but not for the year, but from where we were at the height of the year in January.
Yep. Yeah, I think including today, the big pullback today for the Nasdaq, I believe from the high, it's down 17%. Adding that in today, there's not another 3 or 4, which makes sense. It was down about, I think, close to 3 or 4% today. So it's approaching a bear market from that high. The Nasdaq is, and that's the tech stocks are what's kind of taken the brunt of this, if you will. It's definitely been more widespread. I know banks have gotten hit, things like that, but the tech stocks, I think, have seen the biggest pullback so far.
Yes. And so as far as our sector count, the best sector of the year is healthcare and the worst sector of the year is technology, right? And so that's kind of not a surprise. It's the worst technology quarter in, I think, 25 years, a terrible quarter. So it's kind of interesting. And also what was working somewhat last year was small cap stocks. Well, they've all really crashed. In fact, that's slightly worse than the Nasdaq, down 14.3% for the year and down 6.5% today. So really, really bad day. So we're coming to you on a very unique day. We don't get many days like this. And so then there'll be a little rally and probably a follow through. And maybe we'll go a little bit lower. But, Chris, I'm not sure we see the market going a heck of a lot lower from here. There's enough uncertainty, but it doesn't feel like we're going to have a terrible recession or some disruption with this tariff situation. But it doesn't feel like that, does it?
Yeah, I mean, it doesn't feel like it yet. Or as I would say, as of we see right now. I mean, I do think, as we'll talk about a little bit, sentiment is starting to roll over a little bit, but the jobs market has so far remained resilient, which is a positive. I think so. There are things that are playing for the U.S. market overall. I think this next quarter, what we'll probably see is, almost what people call like an earnings recession. You are going to have a lot of CEOs that when we go through this upcoming Q2 earnings season.
Yeah,
they're going to revise or even their upcoming earnings and projections because the tariffs are going to throw uncertainty out there, and a lot of these CEOs, it's their job to navigate this, right? They don't want to say they're going to do one thing and then come under that that could significantly hurt the stock price. They would rather adjust it in the short term, bite the bullet, and then beat those down the line. So we're probably going to see a lot of that in Q2 here. So we could see some volatility ripple through. But at some point, we're going to get that almost, it's going to rebase, right? You're going to get that kind of that reset button that's going to reset where expectations are. And then hopefully from there, we kind of start to climb back up, or at least stabilize and then climb back up. So we might be it. I mean, that's the challenge, I think, in Q2 that we could see. But I mean, I think the other, like we talked about, this is very event driven. I mean, we could see events that happen for President Trump next week that could drastically change the entire sentiment of the market. We could see everything kind of flip on its head. I mean, there's a lot of things that could change day to day, really.
Yeah. Well, so let's talk about the economy. But before we do that, Chris, I want to talk a little bit about our reaction to all of this, right? So we've been investment managers now. It's my 41st year. And about 30 years ago, we designed a program that we now call, which evolved over time. It's called the FourStar Protection Plan. And so we figured out that in bad markets, if you can avoid loss, and then you're fully invested for 85% of the time when the markets are just going up normal, that's the normal state of affairs normally. As the markets are going up, and they'll correct a little bit, but then they go back up, down a little bit, but the trend is generally up. Then about 15% of the time, we're in correction territory, which is where we are right now, and then outright bear market when the economy gets really, really bad. So if we can avoid that period and we can see those trends developing, and we had a set of probability signals that we developed that give us high probability that we need to take protection, that the market could go lower from there. And it's not foolproof. It's not always right. But the indicators have generally been very good, about 75% chance that they're right. So we're in negative territory now. And now we have 4 different positions to go from maximum cash to maximum protection. And in 2 of the portfolios we run, we'll go to 50% cash. And then 2 of the portfolios that we run, we will go to 100% cash in the right conditions. Now, one of those portfolios is a multi-asset class, as you know, and that one can own commodities and currencies and other things. And right now, that portfolio is commodities and cash. Has almost no stocks at all. In fact, no stocks at all, because that's the signals that we're getting. And the one other portfolio that's 100% cash is 100% cash. And the 2 moderate portfolios that go to 50% cash are at 50% cash. So we are now at the maximum level. And some of our listeners have heard this story before. We developed these indicators, but yet, the markets don't usually crash, right? We're not in that kind of a mode all the time. But when they do, it's hard and everybody's stressed out and people are calling, markets are rough. And so that's kind of where we are right now. In fact, I got 2 or 3 calls just while we were sitting here on this podcast that I have to return. But the reality is we've only had to go to maximum cash levels where we are right now 8 times in 31 years. So we don't do it all the time, right? It's not a regular activity, but we certainly are there now. And it's not as bad as most markets. Some of the markets have been down 30, 40, 50%, like in 2008. So we're only down, single digits and maybe slightly double digits in the case of the NASDAQ, but down from the high. So it isn't the worst performing market, but the internals and all the indicators we have look really, really bad right now. And so we're maximum cash. And while the market goes down 5 or 6% today, our portfolios may be down 1% or something. So the protection plan has severely limited our downside and protected our clients. And in 2022, we did this last time we had to do it. And our average client was only down about 8%. And the markets were down 19, 25, 33 on the NASDAQ, and techs were down more. And then everybody remembers the pandemic year when the market was down 37%. And our average client was down no more than about 12%. So it does help. It does protect the accounts. And then if you have a lot of cash at the bottom, you get indicators to get back in. And then we'll get back in. So we're not betting on the downside when we do this, are we, Chris? We're not betting on it.
No, I mean, we're just we see that volatility. We see the maybe a softness, you could say, in the market, a seller's market per se. And we take that protection, like you said, Ryan. And once we get those signals to get back in, I mean, we're not sitting here trying to time the bottom. We're not trying to predict the future. Once we get that kind of that bottom, we see that, or we start to see it moving upwards, we'll start taking those steps to kind of dip our toes in and slowly start to kind of and that's a key, is we don't just go from cash to fully invested in one swoop, so we start to kind of dip our toes in, and as we see more and more proof and more, we'll continue until we get to the point where we're fully invested. And the key as well is we're not just buying the pure S&P or anything like that. We are also overweighting sectors. We're taking other strategies to hopefully gain even more alpha on that way up. If tech is at that time running again, we'll be in tech stocks, or we'll start to overweight tech if we see that off the bottom, if those are the ones that are exploding off. So there are ways on top of that we can gain even a little bit extra kind of when we're catching up, because it's almost impossible to really time the bottom. And people that say they can, I mean, it's so hard. So we're always going to miss the bottom most likely, unless we get really, really lucky. But we can play catch up. And even if we miss that first 5%, by protecting downside, 15-20%, we can save our clients a lot of damage.
Well, and then a day like today, they'll say, God, you guys are really smart, because we got our final fourth signal a week ago Friday, about 7 trading days ago. So yeah, we look really smart right now, but we didn't predict this day. We had no idea it would be this bad. And likewise, you don't predict the up days either. Although the irony of the market and the cruelty of the market is the biggest up days you'll ever see are in bear markets. So now we had such a bad day, we could have a big up day tomorrow, or maybe a couple of days from now. And then all of a sudden, everybody's excited. We have a big up day, and it's bigger than most up days in a bull market.
Mm-hmm.
But that could be just the pause that refreshes, and the market goes right back down, right? And that's often what happens in declining markets like this. So, so the same indicators, as you say, Chris, that got us out will slowly get us in. So we try to relate it to, instead of like a light switch where you turn it on and off, it's a dimmer switch, right? So you slowly dim it down, then you slowly turn it back up, right? So we go on a series of 4 moves, and that's a sensible way to do it, because there's no way you can guarantee a trend. Trends develop over time. And so we just see a series of indicators. We get a quarter of our indicators turn negative, then we'll go to that first position, another quarter, we'll go to the second position, another quarter, and then we get all of the indicators negative. That's when we make our final move, right? And so how we do it. And this is the same identical thing going back in. And so we need higher highs on the market and higher lows. The market goes up, hits a high, pulls back, and then goes higher than the previous high. And then the low, after you pull back, is higher than the previous low. And that kind of pattern activity, then it'll start showing up in our indicators, and we'll slowly get back in. It usually takes about 2 months at least to get us fully back in the market. So we'll never be in at the bottom. But we really don't need to be. We've gained so much alpha, meaning the alpha is defined as return above benchmark. So we've gained so much advantage on the benchmark on the way down that we're giving some up on the way back up. We'll probably retain some of that advantage, and that's what happened in 2020, and that's what happened in 2022. So relatively, those are some of our best years. In 2020, the pandemic year was our best year on the upside, because the markets came all the way back up, and we're up 18%, and our portfolios are up in the 20s and 30s because we had a big advantage. And in 22, we were way ahead, but that was on the downside. Markets ended down big, but we were not down big, right?
Yep.
So that's nice. So that's our posture. And as we sit today, we're at maximum cash levels. We only do this very, very seldom, and we only sit in this position for usually only about 6 to 8 weeks at a time. But here we are today, Chris.
Yep. Yeah. I mean, about usually 2 months at 6 to 8 weeks. And it's exactly right. I mean, I think, we'll just wait and see. I mean, I think the hard part is kind of plans out exactly. We're not sitting here. We're not trying to calculate GDP. We're not trying to calculate all these crazy things. We're just watching the trends. And then when those trends start to form and start to point to more of an uptrend, we'll start kind of slowly dipping our toes back in the water. And, hopefully at that point, we're coming out of this volatility spell we're under right now.
Yeah, exactly. So this is a time to protect your accounts. And then now, of course, what's going to turn this thing around is there's a perception that the economy will be okay, or that the markets have corrected enough that even though the economy will slow down, the market's going to plan to, look 6 or 8 months out or 1 year out and say, hey, the market will be higher, so we better buy now. That's kind of the mentality that get markets to bottom and then people getting back in. So let's talk about that economy, Chris. What does the economy look like? I know you have a number of indicators. This is a light week for economic numbers, but what do we see right now?
Yeah, I mean, kind of some mixed data, which is, I guess, how it's really been this year. Really, it's been kind of mixed data, but a couple positive things. The Q4 U.S. GDP number came in. This is the final number, so they kind of come out with a preliminary and then they revise it. The final for Q4 was actually revised up 0.1% to 2.4 from 2.3%. So that's good to see. The ISM manufacturing activity level on the flip side fell to 49 in March from 50.3 in February. So anything below 50 is kind of contraction territory. So, obviously in February is barely above that 50 mark. So it didn't have a huge drop from that standpoint, but obviously falling into contraction territory is not something, we want to see. University of Michigan Consumer Sentiment Survey came in at 57 at the end of the March. That was the final March reading. That's the lowest level since 2022. So the last time you really had a big volatility spell like we're getting right now, I would say. And that's down from 64.7 in February, the reading then. So I think the biggest thing that consumers are looking at, 2/3 of the consumers in that survey said they expect higher unemployment in the next year. And that's the highest reading since 2009. So we're starting to see, and that doesn't really mean a lot. That just shows what the sentiment of consumers and people are. And obviously we're a lot of the consumers are feeling some fear as far as, job security, things like that. So that can change drastically month to month. We could see that bottom there and move back up. Who knows? But we are seeing that play out as far as consumer sentiment. On the flip side, kind of the jobs market so far that we've seen has actually held up relatively well so far. On the week ending March 29th, we had 219,000 initial jobless claims, and that's compared with 225,000 the week prior. And that was less than the expectation of 228,000. So we're not seeing as many layoffs. And then the ADP National Employment Report, which is private payrolls, shows the U.S. added 155,000 new positions in March, which was up sharply from the 84,000 number posted in February and beat expectations of 120,000. So, kind of flip side, obviously, we're seeing a little bit of consumer sentiment wane a little bit, but so far the jobs market has held relatively well. So, if the jobs market continues to hold, that's positive. If people are making a nice steady paycheck, they have money to spend, things like that, that is a nice boon for the economy, if you will. We'll just have to kind of see how it plays out, though. Obviously, a lot can happen. We could see the next jobs numbers start to roll over, which, will imply something drastically different. But from what we see right now, jobs market looks strong. Sentiment rolling over a little bit, manufacturing as well. But the GDP number being revised up is a good thing as well.
Yes. So Chris, interesting set of scenarios here. So in the last couple of days, we've seen some economists come out and say, because things look slower and then the tariffs are going to cause the economy to slow down. That's what they think. So that means that they thought the Fed was going to lower interest rates maybe twice this year. And now there's a few economists saying, oh, now they're going to lower 4 times. So the next couple of meetings are going to keep lowering interest rates to keep the economy going. Then on the other hand, inflation has still been stubbornly in the high 2s, and the core inflation is still over 3. and they got to get inflation down below 2. And some economists are saying that tariffs are going to cause inflation. And if that were to happen, and I think that's unlikely, I'm just going to put out a prediction there, but some think that it will cause some strong inflation again. And if that's the case, then you wouldn't lower rates. And some economists are saying they're going from 2 rate declines as a prediction to no rate declines. So we got people going in totally different directions here. What I think is going to happen in this economy. And I guess we always joke that's why they call economics the dismal science, because there's so many factors that people can never really know exactly how it's going to play out. But we see things develop, and then certain things, high probability, could lead to other things, and there's correlations and probabilities and all that kind of thing. But then just when you thought you had it all figured out, it does something different, right?
Well, and I think that one important thing to point out, I mean, inflation is, a simple way to think about inflation is a supply and demand imbalance for the most part, right?
Right.
If you have an increase in demand, same amount of supply, the goods get bid up and they're just going to go higher and higher prices if you don't decrease that supply. So, what we're seeing here is potentially with the tariffs, maybe potentially a decrease in supply. But if we see the economy maybe start to roll over, jobs market roll over a little bit, you could see a converse decrease in demand. And like you were saying, we might not get inflation. I mean, if you have that demand decrease a little bit as well, or even stays the same to a degree, we could see that. So there's a lot of variables, I think, that could play out there. But I think to your point, Brian, what you said is, I don't think anyone really knows what's going to happen. I don't even think the Fed knows. I think it could go anyway from completely left field one direction to completely left field the other direction,
Yeah. Well, and so far, the best performing area has been the commodity area and the healthcare, like I said, healthcare stocks. But even those got hit today. So the copper stocks are down. Copper's been strong. Gold and silver have been really strong. And we have in the dynamic portfolios of gold and silver positions, and they've been really strong. They were down today as well. So today was a day where I'd say it's kind of like a sell them if you got them day. Everything's gone down on a day like this. Even the good stuff's going down. So that's kind of what happened today. But those have been the strongest areas. And again, we've seen that in the indicators, Chris, that you read off in the beginning of our episode here, where commodities are gaining on other asset classes, and we're also seeing currencies still do a little bit better as well. So the dollar's been a little weak, but yeah, generally been strong but a little weak. So now. Back to the rate issue, Morgan Stanley predicts only 1 rate cut now. But the other interesting fact, and this is why people can't figure out what's going to happen to the economy. We've seen Rockwell Automation. We've seen a whole bunch of different companies announce that they're building plants in America. Taiwan Semiconductor, largest semiconductor producer in the world, they're obviously in a tenuous situation with China. There's fear that China's going to come into Taiwan and take over Taiwan. And they have agreed to build a 40,000 employee plant in northern Phoenix. In fact, we're investing with some real estate developers that can't keep up with the demand for rental homes in the Phoenix area because of all this new business coming in. So the estimate now is, Chris, even though we're seeing tariffs go up and a lot of disruption, there's industries like the auto industry that will be bolstered by these tariffs. And we're seeing they're estimating about 500,000 new jobs are coming into America because of the plants that are announced and being built here. So we're seeing some real big positives, and that's what President Trump is looking for, right? And in some way, and then also getting the playing field to be better for American business and frankly for all business worldwide. If people lower tariffs, then it is really free trade. And everybody says we're free traders, but there really has never been free trade in the world. When everyone has tariffs on everybody, that's not free trade. And so now I think President Trump is trying to get people to approach free trade more seriously. And then it will certainly help America because we're a very efficient economy. And frankly, being a very efficient economy and very successful economy, the most successful economy in world history, we've never really been paid for the value that we've created in many ways. And that's what President Trump says. And I actually believe he's right about that. because if we've been tariffed and blocked from doing business with people, even though we have a great economy, then there's no way to get that value. But now the tariffs will probably bring in some of that value, and it'll probably help the budget deficit a little bit because we had 2 trillion of structural deficits. So besides the Doge group that's cutting, we didn't even talk about that today, Chris, the Doge group cutting all that spending. They're estimating this to cut a trillion in spending within a year. And if there's tariffs coming in, they're estimating about 700 billion of new capital to the United States government. We may actually get rid of our structural deficit, which is a good thing.
No, yeah, I mean, I think that, and that's another, I think, big X factor, right? Is the cuts, and we've really never seen anything like that to the extent that, you know, you're getting cuts on the government jobs, things like that. So I don't know if anyone really knows the impact that's gonna, you know, as that ripples through too. So there's a lot. I mean, I think economics, as you said, is a dismal science. I don't think sometimes 1 + 1 doesn't equal 2 in economics, if you will. So, you know, I don't think anyone can necessarily predict it. I think that it'll be really interesting to see. I mean, I think that it'll be interesting to see how this kind of plays out.
Yes. So it's quite a day. It's quite a day to do an episode. And fortunately, we've got some good protection for our investors. And if you don't have protection, it's probably not too late. Our trends still say that markets could go lower, but it's just a probability. Could be wrong, right? So we have to just be careful out there, everybody. And Chris, we haven't seen some of these things since 2008, but the new job numbers coming in are pretty amazing. So that's it. And Chris, what else do you have with our group today? Anything?
Yeah, just a couple things. I'll just switch real quick, switch gears to the international front. We've seen a couple interesting things in the Asia Pacific theater. So a couple numbers came out of China. Their Caixin Servicing Purchasing Managers Index rose to 51.9 in March from 51.4 in February. So that's the Chinese service sector. Sort of a little bit of expansion there. And the Chinese Manufacturing Purchasing Managers Index came in at 50.5, which was a slight acceleration from 50.2 posted in February. So a lot of this, what's going on in China, is actually due to some of their redoubling efforts to kind of pump up their economy through government spending. A lot of this, the highlights of this was infrastructure spending as they ramp up. And with these, we really haven't seen the exports get hit yet. So it'll be interesting to see how these get impacted in the next couple months. And more importantly, the Bank of Japan governor came out and said that they are keeping a keen eye on their interest rates in the coming months as food inflation continues to heat up. We could see the Bank of Japan continue to raise rates, which will be really interesting. I mean, we talked on a couple podcasts now that their rates were negative for a while, and just recently they brought it back to kind of neutral. So that'll be really interesting if they continue to have to raise rates. And the European theater, consumer prices were up 2.2% in March, and that was down from 2.3% in February. So in the EU, it seems like inflation is actually holding a little bit lower than in the US. So what does that mean? We could see the ECB prompt another potential rate cut there as well. And this has major impacts, you know, not only for the dollar, but trading, a lot of that as well. So it's the only reason we kind of mentioned this. And then on the commodities front, big news today, oil. So oil was already getting a little bit beat up just due to these tariffs we're talking about and the potential constriction on maybe trade, things like that. But then OPEC Plus came out today and said they are agreed to advance their plan to phase out oil cuts, production cuts. So they plan on increasing oil production by 411,000 barrels per day starting in May. So oil actually was down over 6% today based off of the tariff news and the new potential production coming on the market. So that is going to impact commodities. That's not all been the commodity move we talked about, hasn't all been oil, but that does obviously help it. So we'll see what that does, you know, how that plays out.
Right.
And then the last thing I'll mention, it is, well, not March anymore, but we're just getting out of March with March Madness. So the NCAA men's tournament Final Four are here, and it's down to just number 1 seed. So it wasn't much of a madness to the tournament this year, if you will, was we got all number one seeds for the final four. And the last time this happened was in 2008. So yeah, it's kind of crazy when you look at statistics wise, you look at the tournament and everything. And you know, when you have that competition and the unknowns, it's always crazy when you get the predicted output, right? I mean, everyone, if it was logical, it would always be number one seed. So
Would be.
interesting.
What are the odds? First time since 2008.
So yeah,
Like this, like a lot of the things we're seeing in the market.
right.
There's a correlation there, Chris. I don't know.
I don't know. Hopefully not.
Well, cool. Well, thank you, Chris. I think we're almost done for the day. I do want to point out to everybody that you know, we do back up these shows with other data on the leadership matrix, which is the blog post right on FourStarWealth.com. And you can go into all the blog posts of all of our advisors. There's the optimized investor. There's the leadership matrix, and a couple of other blog posts up there. So we're going to have a piece up there all about these tariffs. If you want to dig in further or learn a little bit more about it and what these tariffs could do to the economy. But it is somewhat an uncertain thing. But we're trying to put out as much information as we can about there so folks understand it. So, well, Chris, now the markets are closed and we can relax a little bit until tomorrow. We'll see what tomorrow brings.
That's true. We'll see what Friday brings.
That's right. Well, great. Well, I think we're about done for the day. Thanks everybody for being with us. We'll be back again and we'll see what happens over the next few weeks. We've had a rough 6 weeks here, and now today was the worst day, fifth worst day ever in the stock market. And we will have better days, right?
Yes, I think there will be. I mean, won't last forever.
That's right. So there's still opportunity in the world, and let's all be positive and optimistic about it. We'll leave it there, everybody. Thanks for being with us today at today's Market Explained. We'll be back in a couple of weeks with another update. We're also going to be doing some really interesting interviews this spring. So we'll come back to you with some interview episodes as well, including Joe Hart, behavioral finance expert, help us think better about the markets and how we react and how we make decisions when we're making investing decisions. So, okay, thanks everybody. Thanks for being with us, and bye bye for now, Chris. Right? Bye bye.
Yep.
Bye bye everybody. Thanks so much.